Hello, everyone, and welcome to Investing and Trading Live. My name is Josh Lopez, and as always, we are talking about the financial markets, how they work, different techniques and strategies on how to make smarter investing decisions. Today, I do have a good friend and a good pal, and he is a special guest today, Mr. Luke Young, talking about a few different topics here today. He's going to be bringing in some knowledge and dropping some bombs on futures G-traps. It's a strategy that he's going to talk about in the financial markets. Also, some different techniques and concepts on asset allocation and how to, we'll call it, boost your potential portfolio, whether the market's going up, down, or sideways. Without further ado, I'm going to hand it over to my good friend Luke, and he's going to talk about these topics. And it's good to have everybody back, and we will see you all soon. Here you go, Luke. Thanks for coming on the show, and it's all yours.
Thanks for having me. It's like my first appearance in my 2 years knowing you, Josh. But I wanted to come on here and talk about futures G-traps. A lot of people don't know about them, especially if you're trading futures. You definitely at least should be aware of them. And, just to break it down, the futures market gives you so much leverage, right? You can be dealing with thousands and thousands of dollars if you're doing it correctly, but your risk is assessed before you get in and out of trades. But if you're doing this correctly, so essentially a futures G-trap is at market open. It's the previous day of the futures market where, let's just take the S&P for example, where the ES, it's the futures contract, is trading down from 5 o'clock to 8:30 in the morning. Knowing that it's down, the S&P on the stock market is obviously going to open down as well. And when the stock market opens down, you have all these retail investors that get a little spooked, and they have stops in place to where they also start selling in the market. So the SPY opens down, and generally if you're opening into a G-trap, people will start to sell, because they're spooked. But what they don't realize is they're selling right into a powerful demand zone, and these are shown on many charts, which is why they're considered a G-trap, a demand zone that is pretty much just seen from the S&P, where big banks and institutions are waiting to start to buy in. So all these retail investors are selling their positions, they're getting out, they're all pissed off for the day or whatever, and here we are waiting to buy. Because once you buy these shares in a demand zone, typically price tends to go up. And if you're wrong, you have a stop put in place, obviously, with any trade. But generally, you see this a lot in the markets, and it's a great strategy, right at 8:30 in the morning to enter in, and there's tons of room for opportunity in there the upside.
Let me ask you this, Luke. With that, obviously, you don't want to be just going and buying or selling just because of those reasons, right? You have probably areas of interest. Maybe potential supply and demand zones. And as Luke is talking about some of this stuff, obviously we're not recommending any buying or selling on the show. This is all for educational purposes, but that's really an odds enhancer. Would you call it more of an odds enhancer to increase your probabilities?
It definitely stacks your probabilities, and areas of supply and demand will always stack your probabilities. Knowing where positions of imbalance were in the market that turn the market, knowing where those are on a chart is extremely important. You need to know where those are.
Cool, thanks.
But yeah, as well, do you do any futures yourself?
Yeah. I do. I started out with the 30-year bond. Mm-hmm. 30-year bond is a futures contract. It trades $31.25, if I'm not mistaken, per tick. So these, as Luke was talking about earlier, the futures market, they don't run in, pennies like the stock market does. They do ticks. And each tick value is different based on each contract. Like the S&P 500, each tick on the normal contract is $12.50 per tick as well, $50 per point. So I started off with the 30-year bond. I do like oil. It's a nice fast mover. Would you say the G-trap Is it typically just on the S&P 500?
No, it can be on anything.
It can be on anything. Okay, so it's basically, so explain what the Globex market, what that actually means. I don't think you explained what the Globex is.
So are you just saying that?
What is the Globex time? So basically, you have regular market hours,
Right,
and you have the Globex market. It's Central Time would be, 5 p.m. until...
Yeah, so you're saying the market hours of the futures market.
Correct, yeah.
So how would you best explain this? 24 hours, obviously, are in a day, so the futures market is open 23 hours, 5 days a week, unless there's a holiday. Mm-hmm. And the only break is 4 to 5 p.m. Central Time. So you can basically, technically, in the middle of the night, be trading the futures market because it's open. And the reason it's open is because you have people overseas that need these markets open and, have their own trading times, which is where futures and Forex have these 23-hour markets, which, is very, very beneficial for a lot of people that maybe work a 9 to 5 and can't trade the stock market or options market. They need an additional way to generate income or look at longer term things. That's what these markets can give you.
Mm-hmm. So the Globex is the overnight session then?
Yeah.
Okay. So 5 p.m. until 8:30 a.m.
Correct. And that's I'm glad you brought this up. So the 5 p.m., so when the market actually opens again for the futures market, because you have the 4 to 5 break. So from 5 to 8:30, the open of the U.S. stock market in Central Time. If the market is down on any futures contract and you find an area where a G-trap could possibly happen, that's when you're going to get a open down in the stock market on, some of these stocks, and you can really, really benefit from these G-traps where you're buying these shares up, buying into demand where people are spooked in the morning selling their shares.
Yeah, so essentially you're kind of talking through the fear and the greed of the public.
Yeah.
When things open up really well in the morning and say the market gaps up higher, you get a lot of the novice traders or the retail traders say, oh, hey, the market's looking good, now it's time to buy. But if you think about that, they're buying after prices already went up. Mm-hmm. So they're buying high with the hope to sell higher. What you're doing is you're talking through, we have an opportunity where it might be counter what the public is doing. Because the stats say, if you look at any research, heck, you could even Google this, the percent of retail traders that actually make money, it's pretty low.
Very low.
You want to trade like the institutions, and trading like them is supply and demand at its finest.
It seems like these banks and institutions, they kind of realize where retail traders kind of mess up or get spooked. And it always tends to be where price turns around. There's like a breaking point for most people, and I don't know how they figure this out, but, just like I said earlier, people are selling their shares in the morning because they don't want to lose anymore, which is fine. You have to have your risk assessed. But it always seems like price turns around right there. And, you just got to learn how to follow these banks and institutions. It's just something you have to do to survive in this market, in this world.
I like how you brought that up. You even said, I don't know how they find it out. And really, they're not, if anybody that's done some trading and investing that are listening to the show here today, sometimes people say, yeah, the brokers, they know where my stops are, and they know when I'm getting in and when I'm getting out. Well, technically, yeah, but are they really paying attention to small accounts? If, say people have a $5,000, $10,000, or $100,000, or maybe even $1 million account, that doesn't move the market. So what they know is what the public is looking at for information. Most people are looking at YouTube, all that garbage that's out there, old dated books, all this technical analysis, and it's really the emotions is how they know how the public is trading. So essentially, it's just an exchange of money from the people that don't know what they're doing, which is the public, to the people that do it. As Luke is alluding to, is understanding how the institutions move the market, because roughly 80 to 90% of the activity is actually institutional money. So us as the public, we're just needles in a haystack. We want to trade like them, which is jumping on their coattails, as Luke was alluding to. Mm-hmm. So we wanted to cover some topics on asset allocation. What do you mean by that, and how can that be a potential benefit? Just understanding what that is for our listeners.
Yeah, so I wanted to talk about this. I could talk about this for hours, but we're limited on time here.
Well, we got ours. I mean, I know you got a workout coming up.
Yeah, I got to hit the gym. I'm not feeling too good today, but asset allocation. So this has something to do with retirement accounts. Everybody should have a retirement account, whether it's an IRA, a 401k, or some form of retirement. If not, that could be troublesome when you get to that age when you're trying to not work anymore. But a lot of people, when they have a retirement account, maybe you're not self-directing, maybe you have a financial advisor, but a lot of people think that they are diversified because they have 20 different stocks in their accounts. But what you don't realize, and what probably 95% of people don't realize, is you're not diversified at all. If you're long 20 different stocks and the S&P crashes one day, which is the S&P 500, crashes 50% overnight, most of your stocks are going to be down 50% as well or more. So there's no form of diversification in that account at all. So what people should start realizing, or maybe even look into, asset allocation in a 401k should be positions. How can I best explain this? Positions that are not correlated and diversified. But how do you find that? And I'm going to talk about this. It's not buying different stocks in the S&P 500 or the Russell. It's looking at different index funds. It's looking at bonds. It's looking at gold. It's looking at, maybe a few different stocks to truly diversify. And they have to be uncorrelated, because if one market crashes 50% overnight, you have to have a market that's not going to be crashing 50% overnight to kind of save your behind. And you can do this on a ton of different things. I mean, when I first started, there's a lot of different websites. Josh, I know you look at some of these too. There's something called the correlation matrix online if you Google it. And what you want, let's just build a fake portfolio here. So let's say you have a 401k of, let's do a fun number of $500,000. And you want to put 33% into stocks, 33% into bonds, and 33% of it into gold. That's something you could do to be diversified. But you want to, as far as asset allocation, you want to look at the performance of some of these indexes as well to determine how much allocation goes into each, if that makes sense. Am I explaining that well?
Yeah, so I like how you mentioned the different assets, and if you think about it too, you want to be in some stocks. I mean, stocks they do have their place. It's a great asset to use for wealth generation. But when are you buying stocks, at the highs or the lows? But also being in other assets like futures. For example, when Luke was talking about correlations, or more so inverse correlations, corn isn't going to be moving the same direction as the S&P 500, or gold probably won't be moving in the same direction as lean hogs. There's no correlation there. So having different assets in there, but also still using supply and demand based on when you think something is actually cheap or something is expensive, to have the right investing decision, and keeping those inversely correlated, so that way, like the old saying is, you don't have all your eggs in one basket.
Yeah, I love that you brought that up, because I've met so many people that say, oh, I don't have all my eggs in one basket. I own Apple, I own NVIDIA. Do. Yeah, you actually do. You basically are just long the market. So if the market crashes overnight, you crash, and you're not going to come the next day because you're embarrassed that your account's terminated. But people should really look into this seriously. Even just look at correlation matrix, simple as that. And if you currently are long in the market, maybe look at the correlation matrix and see, if your account is correlated or not. And remember, you don't want it correlated. You want to build an account that's uncorrelated, that you can allocate some of your capital to each of these things and truly be diversified.
I like that. Do you have any particular stocks or exchange traded funds or anything that you like to monitor and look at when in a longer term portfolio, or is it hey, what is the market telling me, and what are you going to give me, and what are my opportunities?
Yeah, I wanted to touch on this too. So ETFs, which are exchange-traded funds, a lot of different countries have their own. So, like, obviously the USA is typically just, the S&P, you have the Russell, and the other markets, I find a lot of success in finding outperforming ETFs in other countries as well, because they're not correlated to the U.S. markets. So I kind of like holding some positions in like the Brazilian ETF or maybe the Chinese ETF, even, well, depending on supply and demand. But, I mean, these markets are just as strong, if not better, than our own. So I like kind of looking at those. I like looking at bonds, which is TLT on the stock market, gold, which is GLD, and then obviously you look at the SPY. And then within the SPY, you can look at some stocks, and some strong stocks right now, Josh, I think are within technology.
Yeah, well, you look at Apple and NVIDIA. I got a price chart up right now, just looking at that. And we talked about this on the show yesterday and the day before. NVIDIA and Apple both at or near all-time highs. So those are obviously tech stocks. Meta has actually been a performer as well. The past, we talked about this the other day too, ever since November of 2022. So the past 6 months roughly is up about 210%. Actually, even more than that, 230%. So tech has been pretty heavy over the past 2022, and a tech ETF would be the Qs, the QQQ. That's the Nasdaq, and that's really been mirroring what those stocks are doing. And what's really unfortunate is some of these tech stocks, Apple, NVIDIA, Meta, they're really the ones that are propping this market up. So moving forward, who knows what's going to happen with that? That's why you do need to be diversified. You do need to have multiple assets in your portfolio. So if one does crash, like we've seen over the several times, the other ones are performing. So it's kind of balancing that portfolio out. And just to kind of throw some more exchange traded funds out there, you have XLE, which is your energy sector.
Yeah, sectors are huge. I forgot to mention, but I love looking at sectors.
You got XLF, which is your financials, XLV, which is healthcare, XLI, which is industrials, XLP, which is consumer staples. I mean, we could go on and on about these. So just some different opportunities that people might be able to start to utilize in their portfolio once you understand how to properly diversify, and then when to get in, but also when to get out.
Absolutely. So. And when to get out is a great description right now. So the ticker symbol IYR, which is an ETF for real estate.
Yep.
It was entering supply last week. It hit the supply zone and the real estate ETF started to just completely fall. Meaning if you own any stock with a real estate company or even that ETF, your portfolio is probably hurting.
Yeah, you're talking about that 86 to 87 area where it's really been dropping since then from actually Monday. Friday got into that zone, and from there it's dropped roughly about just around 5.5%. So rather than keeping it for the long haul, there's opportunities to get in, but also get out, realize your profits. If you are a person that does only like to buy, why not buy back in at a discount rather than just hope it goes up forever, which, as you know, it does not.
Yeah, so I'm sure real estate's going to hit that supply drop to another demand zone. So identify the demand zone, and you can go long in some of these real estate stocks or ETFs when it hits that demand.
Yep. And who knows what's going to happen with interest rates. I mean, and a lot of that was kind of one of the catalysts was probably Powell talking on Wednesday about they're going to be probably raising interest rates again, which will most likely hurt the real estate sector as well. So great insight, Luke. I appreciate the information. We'll definitely have to do this again on the show here. We'll have to find a new topic. If you have any topics, if you're listening right now, that you want to cover down the road, make sure to post a comment in the podcast if you're listening on Apple Podcasts, iHeartRadio, or Spotify. Also, I believe we're on about 10 other podcast sites. A lot of them I haven't even heard, but looks like we have a lot of listeners from there. So thanks for listening to the show. As always, same time, same place next week. Until then, retire young, my friends.